PayPal is down more than 4% after reporting earnings. It was actually down much, much more. It was down as much as 9.5% after earnings. It recovered a little bit, but it's still down 4% on what I believe is a massive misunderstanding from the market. I'm going to give you a very quick update on why PayPal is down 4%, a little bit on stock-based compensation, my valuation model, and what I'm expecting over the long term in terms of annual returns on PayPal. If PayPal is maybe overvalued right now, as it's up over 20% in 6 months, or maybe it's still fairly valued and maybe it's going much, much higher. So that's what I'm going to discuss, and I really hope you enjoy it. Now, for me personally, this report, wasn't really too bad because they did have a pretty good beat on earnings per share, $1.20 versus 107. Revenue, it was a slight miss, but nothing too crazy. Payment volume is still up 9%. 9%. This is amazing. And you have people, they were calling PayPal a dying company just because they themselves don't use PayPal. But again, it's up 9%. So people are using PayPal. And I'm going to show you the accounts, and accounts have been increasing too. So people are using PayPal. It's not a dying company. It grew 6% in revenues, 8% increase in transaction margin, non-GAAP EPS 22%, and free cash flow 31%, which I'm going to comment on very, very soon. If you look payment volume again, it's been increasing steadily every single quarter. This is not a sign of a dying company, not at all. Active accounts has been very slow, 1% increase. Monthly active accounts also slow, around 6%. Number of transactions up 6%. So things, they don't look too bad for PayPal, and I did have a good beat. And the question is, why is the stock going down? And this is mainly because of a misunderstanding, I believe, by the market, because the company expects, in terms of Q4, $7 to $11 versus the average analyst estimate of $1.10. So this is like 3 cents below the analyst estimate. But I just want to show you how narrow looking and how short-term oriented analysts are and how short-term oriented the market is. Because let's assume they hit 107. This is like a 3 cents miss. It's like the biggest thing in the world. But if you look at this quarter, it beats the analyst estimates by 13 cents. They just had a 13 cents beat. So if they missed by 3 cents on this quarter, is it really a big deal? But this is what the market believes. This is what the market looks at. Short-term oriented, they're always late. The analysts are always late. Like a stock I own, CEG, once it goes right now to like 34 times earnings, they're upgrading the stock. When I was trading at 20 times, when I was buying it, they didn't care about it. Same with PayPal before. Same with a lot of stocks. So they're always late. And I'm not really surprised from their own estimates. And the management did comment on it. And they said they're mainly prioritizing profitable growth. So they're not just trying to grow at any cost or at any price. They want to prioritize, profitable growth. It's likely going to be low single digits, so maybe 3-4% for this quarter, and it's expected to be over the long term in the mid single digits, 5, 6, 7%, which I'm going to talk about very soon. But before I go into my evaluation model, I just want to give, a shout out or credit to this account on X. He did something very good, and he explained it better than I normally do in terms of stock-based compensation and how it affects everything with PayPal, although he was very critical of the company and the report, and I'm not. But this is very important stuff. Cash from operations, they're saying that it went up so much, and it's around 1.4 billion. It's not really 1.4 billion because you have stock-based compensation. And this is something very important you have to know, is that stock-based compensation for PayPal, it's been going down, which is a good sign. And it's been making up a smaller percentage of cash from operations, which is also a very, very good sign. And now it's around $300 million per quarter. So 300 million annualized it times 4. This is around $1.2 billion per year in stock-based compensation, which means whenever you're looking at guidance for PayPal, for example, they're guiding $6 billion in free cash flow. It's not really $6 billion. You have to take 6 billion minus 1.2 billion in free cash flow, which would give you 4.8 billion, which means the free cash flow yield on PayPal isn't really 7.4%. It's closer to 5.8 to 6%. That makes a very big difference. And this is what this person is talking about. And if you believe that, for example, 6 billion in share repurchases are all going to buybacks, they're not going to buybacks. You have to take the 6 billion out of 1.2 billion in stock-based compensation. So only 4.8 out of the 6 billion is actually going to reduce the shares outstanding, because the other 1.2 billion is just offsetting whatever they took out in stock-based compensation. Now, in terms of the free cash flow yield, I did tell you, I did make the calculations. You could do them yourself on 85 billion market cap. The free cash flow yield is around 5.8 to 6%. So I'm going to use a 6% to keep things simple for a free cash flow yield. And if we expect PayPal to grow revenues over the long term around 7%, and we expect all margins, net income margins, free cash flow margins, gross margins, everything to be the same, no margin expansion at all, everything is the same, I would expect the free cash flow to also grow by around 7% per year. So if the free cash flow is 6% free cash flow yield, and you add in 7% in terms of growth, I would expect PayPal to return every single year around 12 to 13% annual return, excluding a multiple expansion. And I'll be honest with you guys, I am not saying a multiple expansion, because 18.5 times earnings for a company that's growing 6 to 7%, it's not too cheap. It's not expensive, but it's not cheap either. So I would not be betting on PayPal going to 20, 22 times earnings in the future. I think 17, 18 times is a fair range for PayPal. So if you're buying PayPal today at 18.5 times earnings, I would expect the return of the company to mirror the free cash flow yield, excluding stock-based compensation, which is around 6%, and you add in around 7% of revenue growth, I would expect around 12, 13% annual return. If you do be able to buy it at a lower multiple, maybe 15, 14 times, then you could have the potential of a multiple expansion, and it could take you to maybe 15, 16% annual return. So for me personally, PayPal isn't expensive here, and it's not the cheapest stock in the market, and I would not be expecting more than 12 to 13% annual return with something like PayPal. I've been bullish on the stock for a while. I did many videos and I've been bullish on it, but it's up a decent amount. And for the multiple, I think PayPal isn't a bad buying opportunity here. But for me personally, there's way better opportunities that could deliver 12 to 13, even 15% annual return in this market. There's a lot of them. You just have to look, and I talk about them on YouTube. If you're interested, you can subscribe and find out. And this is all I have to say, just my opinion, not financial advice. Thank you for watching the video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.